Today, we will talk about hire purchase agreements. Hire purchase is an arrangement for buying expensive goods, where the buyer makes an initial down payment and pays the balance plus interest in installments. The term hire purchase is commonly used in the United Kingdom, and it's more commonly known as an installment plan in the United States. With some installment plans, the buyer gets the ownership rights as soon as the contract is signed with the seller. With hire purchase agreements, the ownership of the merchandise is not officially transferred to the buyer until all the payments have been made. Hire purchase agreements are similar to rent-to-own transactions that give the lessee the option to buy at any time during the agreement, such as rent-to-own cars. They can benefit consumers with poor credit by spreading the cost of expensive items over an extended time period. However, because ownership is not transferred until the end of the agreement, hire purchase plans offer more protection to the vendor than other sales or leasing methods for unsecured items. Like leasing, hire purchase agreements allow companies with inefficient working capital to deploy assets. It can also be more tax efficient than standard loans because the payments are booked as expenses. Businesses that require expensive machinery or startups that have little collateral may use hire purchase agreements. A hire purchase agreement can flatter a company's return on capital employed and return on assets, because the company doesn't need to use as much debt to pay for assets. Hire purchase agreements usually prove to be more expensive in the long run than making a full payment on an asset purchase. They can also mean more administrative complexity and tempt individuals and companies to buy goods that are beyond their means. Rent-to-own arrangements are also exempt from the Truth in Lending Act because they are seen as rental agreements instead of an extension of credit. Hire purchase buyers can return the goods, but suffer a loss on returned or repossessed goods. The disadvantages of hire purchase include the overall higher cost, ownership not being transferred until all payments are made, more complex arrangement and paperwork, causing people to spend beyond their means, and a loss on any returned goods. Here are 5 key takeaways. 1. Hire purchase is an agreement where the buyer makes a down payment and pays the balance plus interest in installments. 2. These types of agreements are generally used for very expensive goods. 3. Hire purchase agreements are not seen as an extension of credit. 4. In a hire purchase agreement, ownership is not transferred to the purchaser until all payments are made. 5. Hire purchase agreements usually prove to be more expensive in the long run than purchasing an item outright. Hope this would help. Thanks for watching.